Welcome to The Explainer. Today, we're putting on our equity research analyst hats. We're going to completely strip away the mainstream media hype, ignore the flashy headlines, and run Verisk Analytics through a ruthless, data-driven financial gauntlet. We are going deep into the 10K, the 10Q, and the historical filings to uncover what's really happening beneath the surface of this massive insurance data provider.
But first, we have to cover our bases. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
All right, let's get into it. Here's our roadmap for this explainer. We're setting the case study parameters, running a brutal 21-model valuation gauntlet, uncovering hidden media blackout flags, doing a reality check with legendary investor metrics, and finally, laying down the verdict on the company's economic moat.
So, setting the case study parameters. We're looking at Verisk Analytics, ticker symbol VRSK. This is an absolute titan in the insurance data analytics space. We're talking a $28.8 billion market cap, trading right around $187.50 a share.
Now, what's wild here is the sheer scale of the cash engine we're dealing with. Look at this, almost $1.2 billion in free cash flow just in fiscal year 2025. That massive cash generation, that's the gravitational center for literally everything we're going to test today.
Moving on to our second section, the ultimate valuation gauntlet. It's time to strip away the narrative and just trust the math. We're running Verisk through 21 distinct financial models to find its true intrinsic value.
We're starting off with Group A, our cash flow models. A standard discounted cash flow, which values the company based on the future cash it can generate, spits out an intrinsic value of about $190 a share. This is totally backed up by their explosive 58% year-over-year free cash flow growth. Unlevered FCF? That brings us to $185 when we strip out the interest expense. Free cash flow to the firm yields $182. But, and here's the kicker, when we look at free cash flow to equity, which is the value specifically for you, the shareholder, it jumps up to $195. Why? Because we have to factor in their incredibly aggressive share repurchases. So across the board, these strong cash flows are creating a really solid floor right near its current price.
Now, shifting to Group B, the dividend and income models. Traditional math here actually severely penalizes Verisk. A standard dividend discount model gives us a value of just $115 a share. And honestly, that's just because their low $2.04 dividend completely limits the pure yield. Even bumping it up to a multi-stage growth model only gets us to $140. But here's the workaround. If we use economic value added, or EVA, which measures true operating profit against the cost of capital, the model jumps to $195 a share. The reason? Verisk's elite 69.9% gross margins drive immense economic profit, totally offsetting that low dividend yield.
Okay, Group C, comparables and multiples. Looking at precedent transactions, we get $180, which reflects the premium buyers are willing to pay for data monopolies. On the earnings side, a traditional PE model sits around $182. At first glance, a trailing 28.8 PE ratio looks pretty steep, right? But here's exactly how Verisk justifies it. Our EV to EBITDA model, which weighs enterprise value against core operating cash, prices the stock at $195. Essentially, they're justifying that expensive price tag with a massive 57.5% adjusted EBITDA margin. That is huge.
Let me tell you, if you only glance at the balance sheet for Group D, you'd think this company was completely imploding. Standard asset-based models look disastrous here. Book value is actually negative because of a staggering 10.42 debt-to-equity ratio, which is mostly from them just hoarding their own stock. A fire sale liquidation value, just $25. But here's Verisk's secret weapon, replacement cost. Think about it. What would it actually cost a competitor to rebuild a proprietary database of 2.8 billion insurance transaction records from scratch today? It's practically incalculable, pushing the true replacement value way past $250 a share.
And wrapping up with Group E, the advanced models. Using Black-Scholes logic, which basically values their future growth pipelines like financial options, our real options valuation gives us $215 a share. This premium perfectly bakes in the massive upside of their new AI rollouts, like XAXAI, as they systematically force the whole insurance industry over to their new Synergy Studio platform.
All right, Section 3, the media blackout flags. We've got our 21 intrinsic values, but valuation is only half the story. If you're just skimming headlines, you'll hear all about EPS beats and revenue in line. But we are equity researchers. We need to pull back the curtain and dig into the footnotes. Let's look at the 7 red and 7 green flags that the financial media completely ignores.
First up, the 7 deep red flags. Number 1, transactional revenue actually dropped 6.5% in Q4 and 4.2% in Q2. The media totally ignores this because the subscription revenue masks the pain. Second, GAAP net income fell 10% year over year, down to $229 million in Q2, but that gets completely overshadowed by non-GAAP adjusted beats. Third, that astronomical 10.42 debt-to-equity ratio. Frankly, it's just too complex to explain in a quick TV soundbite when EBITDA covers the interest. Fourth, a horrifying negative 239% return on equity. Algorithms often misread this as unprofitability, rather than just clever treasury stock accounting. Fifth, rising other expenses hit $104 million in the first half of the year, buried super deep in the consolidated statements. Sixth, their claims segment is really weather-dependent. Growth actually plummeted to 0.5% in Q4 due to mild weather, and analysts hate that. They prefer a smooth growth narrative. And seventh, GAAP-diluted EPS actually shrank 3% in Q2, but the headlines exclusively parrot the 5.3% adjusted EPS growth.
On the flip side, here are the 7 overlooked green flags. First, boring is highly profitable. Subscriptions make up 83% of their total revenue, growing at a robust 8%. Second, that free cash flow explosion, surging 58% to $298 million in Q2. Cash flow statements just don't get the media love that income statements do. Third, they quietly retired 8.5 million shares via a $1.5 billion accelerated share repurchase in the first half of the year, boosting long-term EPS under the radar. Fourth, elite pricing power. Their gross profit margin is holding strong at basically 70%, highlighting absolute niche dominance without needing any flashy PR. Fifth, their EBITDA margin expanded to a massive 57.5%, showing operational leverage that easily outstrips inflation. Sixth, they have 7 consecutive years of dividend increases, recently hiking it 11% to $2 a share, but it gets ignored because a 1% absolute yield feels low. And finally, despite a $4.5 billion debt load, their debt-to-EBITDA ratio remains incredibly healthy at 2.5x. That proves the scary debt-to-equity ratio isn't a real liquidity threat.
Section 4. Time for a reality check with the legendary investors. We've got the intrinsic math, and we've spotted the hidden flags. Now, how would the absolute investing greats view Verisk today? Let's run the stock through their methodologies. Ben Graham, the godfather of value investing, wants a PE under 15 and a price below net current asset value. With a 28.8 PE and a negative book value, Graham would give this a hard pass. He'd probably run away screaming, honestly. Peter Lynch, he focuses heavily on the PEG ratio. With that 28.8 PE and 8% EPS growth, Verisk's PEG sits at a lofty 2.09, so Lynch would pass too, deeming it just too expensive. But what about Warren Buffett? He cares about owners' earnings and a wide economic moat. Sure, the debt is high, but Verisk's incredible return on invested capital and that totally unassailable data moat make this a solid maybe for the Oracle of Omaha. He might just be the one guy willing to pay a premium for those near 70% gross margins.
And that brings us to Section 5, the moat and final verdict. We've run the gauntlet, checked the flags, and consulted the legends. Let's pull everything together into one cohesive synthesis. Here is our valuation verdict. Based on the average of all 21 stress test models, we're calling Verisk Analytics fairly valued to slightly overvalued right now at $187.50. The surface-level metrics, like the high 28.8 trailing PE and those negative asset values, are directly offset by that explosive 58% free cash flow growth and the 57.5% EBITDA margin. Essentially, the stock is priced for perfection.
Now, applying the Morningstar framework, Verisk possesses a virtually insurmountable economic moat built entirely on intangible assets and switching costs. That proprietary database of over 2.8 billion insurance transaction records, it is practically impossible for a competitor to replicate today. This creates switching costs so exceptionally high that once an insurer embeds Verisk software into their workflow, they literally cannot afford the operational risk of leaving. For us as investors, that translates to highly protected recurring revenue.
And crucially, this moat isn't just sitting there. It is expanding over the next 3 years. Management is aggressively transitioning clients onto their new Synergy Studio platform and pairing it with deep AI integrations like Exact AI and Premium Audit AI.
They're digging the trench deeper, maximizing ecosystem lock-in, which directly drives sustained pricing power no matter what the macroeconomic environment is doing.
So here's the nuanced takeaway. Verisk is a cash printing machine disguised as a boring back-office data provider. They're actively cannibalizing their own share count to artificially drive EPS above top-line growth. The business model itself is practically bulletproof, but at these multiples, the stock price demands absolutely flawless execution.
The models are pointing to a company priced at a premium for perfection, but those hidden gap red flags and weather dependencies suggest a potential storm if execution falters. So, which side are you on? Are you willing to pay the premium for an unassailable moat, or are you waiting for a margin of safety? Do your own homework, dig into the filings, and let me know your thoughts in the comments. Thanks for hanging out with me for this explainer, and I'll catch you next time.